Long-lived assets. Example 1. Acquisition of property, plant, equipment. Assume a hypothetical company, Profirini, incurred the following expenditures to purchase a towel and tissue roll machine. Now, we have to capitalize and what needs to be expense. So 10,900 purchase price including taxes. So we have to capitalize this. 200 for delivery of the machine. This needs to be capitalized as well because you cannot use machinery until it is delivered. 300 for installation and testing of the machine. Again, this needs to be capitalized because you cannot use the machinery unless it is installed or tested. 100 to train staff on maintaining the machine. Now this needs to be expensed. This is expensed training cost. We expense them. In addition, the company paid a construction team $350 to reinforce the factory floor and ceiling joists to accommodate the machine's weight. Now, if you don't do this, then again you are unable to use the machine. So again, this would be capitalized. The company also paid $1,500 to repair the factory roof, and this is very important. A repair expected to extend the useful life of the factory by 5 years. So this again would be capitalized. And 1,000 to have the exterior of the factory and adjoining offices repainted for maintenance reason. Now this sentence is extremely important. The repainting neither extends the life of the factory and offices nor improves their usability. So this would be expensed. Now which of these expenditures will be capitalized and which will be expensed? As we have mentioned, the company will capitalize as part of the cost of all of the machine all costs that are necessary to get the new machinery ready for its intended use. Hence 10,900, 200 for delivery, 300 for installation and 350 for reinforcement of the factory floor. So all these four would be capitalized as far as machinery is concerned, and the 100 to train staff is not necessary to get the asset ready for its intended use and will be expensed. The company will capitalize the expenditure of 1,500 to repair the factory roof. Now this is your factory roof, so this again would be capitalized. And $1,000 have to have the exterior of the factory and adjoining offices repainted would be expensed because it doesn't have any impact on the life of the factory. So again, if we come up with the capitalize and expense, so 10,900, 200, 300, 350 and 1,500 would be expensed over here. It was 100 and 1,000. 10,900 for purchase price, 200 for delivery, 300 for installation, 350 to reinforcement of the factory floor. The company also paid 1,500 to repair the factory roof. So this is for the roof, this is for the training, and this is for your paint. Now because painting is not impacting the life of the factory, hence it would be expensed. How will the treatment of these expenditures affect the company's financial statements? Now the costs related to the machine that are capitalized, so these are the costs that would be capitalized. They were going to increase the carrying amount of the machine asset as shown on the balance sheet and will be included as investing cash outflows. The item related to factory that is capitalized, as we have just mentioned, 1,500 roof repair will increase again the carrying amount of the factory asset as shown in the balance sheet and is an investing cash outflow. Same for the machinery as well. Now the expenditure 100 and 1,000 would be expensed in the period and will reduce amount of income reported on the company's income statement. So these two are your expenses and we're going to reduce your income for the year, and they will be shown as cash flows from operations. So over here these are coming cash flow from investing. This will going to go from cash flow from operation. Example 2, capitalized borrowing cost. Builder, a hypothetical company, borrows $1 million at an interest rate of 10% per year on 1st January 2010 to finance the construction of a factory that will have a useful life of 40 years. Construction is completed after 2 years. Now, if it is completed in 2 years, what will be the interest? So, interest would be 1 million into 10% multiplied by 2, that is 200,000. That is your interest. Now, during which time the company earns $20,000 by temporarily investing the loan proceeds. Now, IFRS and GAAP have different solution for this. Now, what is the amount of interest that will be capitalized under IFRS? So, under IFRS, 200,000, from 200,000, 20,000 would be deducted because these are the earnings that temporary investing from the loan proceeds, because it takes some time for the construction and we are not using 1 million immediately, so some of the cash would be invested and we are earning 20,000 from temporary investing. So capitalized amount would be 180,000, and in GAAP you are not allowed to do this, hence the capitalized amount would be 200,000. So the total amount of interest paid, as we have just calculated, is 200,000. Under IFRS, the amount of borrowing cost eligible for capitalization is reduced by 20,000 and 180,000 would be capitalized. Under US GAAP, the amount that would be capitalized would be 200,000. Where will the capitalized borrowing costs appear on the company's financial statements? So, capitalized borrowing costs would going to increase your balance sheet. So, the capitalized borrowing costs will appear on the company's balance sheet as a component of property, plant and equipment. In the year prior to completion of construction, the interest paid will appear on the statement of cash flows as an investing activity. So, it will be investing activity. Over time, as the property is depreciated, the capitalized interest component is part of subsequent depreciation expense on the company's income statement. So, as the balance sheet amount of property, plant and equipment increases, further down the road, this would be reduced by depreciation. Example 3. Software development cost. Assume REH, a hypothetical company, incurs expenditure of $1,000 per month during the fiscal year ended 31st December 2019. So this is December 31st 2019. This is 1st January 2019. To develop a software for internal use. Now this is very important. The software we are developing is for internal use. Under IFRS, the company must treat the expenditure as an expense until the software meets the criteria for recognition as an intangible asset, after which time the expenditure can be capitalized as an intangible asset. So if certain criteria is met, then we can capitalize, until it is not met, we would have to expense it. What is the accounting impact of the company being able to demonstrate that the software met the criteria for a recognition as an intangible asset on 1st Feb versus 1st December? So if the criteria is met on 1st Feb, this $1,000 needs to be expensed and this $11,000 would be capitalized. And if the criteria is met on 1st December, then 11,000 would be expensed and 1,000 would be capitalized. Now, if the company is able to demonstrate that the software met the criteria for recognition as an intangible asset on 1st February, the company would recognize $1,000 expensed in January as an expense on the income statement for the fiscal year 31st December 2019. The other 11,000, as we have mentioned, would be capitalized. So the 11,000 expenditure would be recognized as an intangible asset on balance sheet. Alternatively, if the company is not able to demonstrate the software met the criteria for recognition as an intangible asset until 1st December, the company would recognize 11,000 expense. Now, if the criteria is met at 1st December, 11,000 would be expensed and $1,000 would be recorded as intangible assets. How would the treatment of expenditure differ if the company reported under US GAAP? Now, under US GAAP, if the software is used for internal use, if the software is developed for internal use, then it would be capitalized. That's the rule. So under US GAAP, the company would capitalize the entire 12,000 spent to develop software for internal use. So the entire 12,000 would be capitalized. Example 4, general financial statement impact of capitalizing versus expensing. Assume two identical companies, CAP and now, start with $1,000 cash and $1,000 common stock. Each year, the companies recognize total revenue of $1,500 cash and make a cash expenditure excluding an equipment purchase of $500. At the beginning of operation, each company pays $900 to purchase the equipment. So $900 is being used to purchase the equipment. CAP estimate the equipment will have a useful life of 3 years and estimated salvage value of 0. So the depreciation expense would be 900 minus 0 divided by 3, that is 300. The company have no other asset and make no other asset purchase during the 3-year period. Assume the companies pay no dividend, earns 0 interest on cash balance, have a tax rate of 30%, and use the same accounting method for financial and tax purposes. The left side now actually estimates a much shorter useful life and expense the equipment immediately. So this is for cap. Now is expensing 900 immediately. Now if we look in our income statement and cash flows, so 1,500 cash, we are getting cash expense is 500 and the depreciation will be 300 that we have calculated in the previous slide. So income before tax is 700 and tax is 210. Now cash flows from operations. Now cash flow from operation, this 790 is you are generating 1,500, you pay 500 as expense and you also pay minus 210 for your tax. This is your tax. So 1,500 minus 500 minus 210, what do we get? 790. This is your cash flow from operation. We are also buying $900 worth of machinery. So this would be used or come under cash used in investing. So the equipment is of $900. Next year again, same thing, and cash from operations would be 790. That is 1,500 we are taking as revenue, 500 as your expense, and both of them are cash revenue and cash expense. 210 is your taxes, so we get 790 again. And interestingly, this amount is 0 over here. Why this amount is 0? Because we are not buying any equipment at this point. So we bought equipment at the end of year 1. So that's why it is coming at year 1. Now total changes, 790 minus 900 is minus 110. 790 plus 0 is 790. So these are total change in cash. And we also need to understand we start with $1,000 cash. So these are the changes. Now for now company, 1,500 is your revenue and cash expense is 1,400. Now from where this 1,400 is coming, it is 500 plus 900 that the equipment we expensed, and the tax rate that we are giving extremely low, that is 30, and the net income is extremely low as well as compared to capitalizing it. Now we need to understand that if we capitalize, this CAP is coming from capitalize, then income in the early years is higher, and if we expense, the income in the early year is lower, but the income in the later year actually goes up because our expense goes down quite intensely because we are not buying the equipment anymore. So the first year cash flow from operation would be 1,500 cash revenue minus 1,400 and minus 30. Now 1,400 is your expense and your equipment combined, so we get 70. Now cash used in investing would be 0 because we have shown it in expense, so it is already expensed, it is already coming under cash flow from operations. And the total change surprisingly is 70. It is different from capitalizing, that is minus 10. Now in next year, 1,500 revenue, 500 cash expense, but we don't have any depreciation. The reason we don't have any depreciation even in year 1 is because we are expensing the equipment. And the tax rate goes up quite intensely. It's $300 because the income before tax is quite high. And as we have said before, if we expense early year, revenues are low, early years net income is low, and later year net income increases or profitability increases. Cash flow from operation is basically 1500 minus 500 and minus the tax that we pay 300. So 1500 minus 500 minus 300 equals to 700, and that's the same for third year as well. And if we see that the total change in cash is 700 and 700 in year 2 and 3. And if we look closely, total net income in both cases, cap and now, 490 plus 490 plus 490 equals to 1470. And over here as well, 770 plus 700 plus 700 is also 1470. The reason at the end the net income for the total net income is same, or accumulated net income is same, because we are just capitalizing over here and we are expensing it over here. The basic structure remains the same. And if we also observe cash flow, so cash flow minus 10 plus 790 plus 790, the change is minus 10 plus 790 plus 790. The change would be 1470, and over here as well, 700 plus 700 plus 70 is 1470. Now if we continue, our cash at time 0 is 1000. In year 1, 890. Now we start with 1000. We get, as stated, 1500. We pay minus 500. We also pay 900 as for your equipment, and minus 210 for your tax. So 1000 plus 1500 minus 500 minus 900 minus 210 equals to 890. That is again coming over here. For the second year, 890 plus 1500 minus 500 minus 210 is 1680. We are not deducting 900 anymore from here because we are buying the equipment only once in year 1. So this is 1680. And year 3 again, 1500 minus 500 minus 210 equals to 2470. So over here cash is 2470. At time 0 we don't have any property, plant and equipment. At the end of year 1 we have 900, that is your property, plant and equipment, minus 300 your depreciation. So we have 600. We again deduct minus 300 as your depreciation, we are left with 300, and if we again deduct 300 we are left with 0. So total asset would be at time 0, 1000. Year 1, 890 plus 600, that is 1490, 1680 plus 300, 1980, 2470 over here. Now retained earnings, at the start we don't have any retained earnings. At the end of year 1 our net income is 490, so your retained earnings go up by 490. And then again we have a net income of 490, so 490 plus 490 we have 980, and plus 490, 980 plus 490 we have 1470. Each year we have a net income of 490, so at the end of 3 years we have 1470, and these are your common stock that remain constant, and hence total shareholders equity is 1490, 1980 and 2470 for each subsequent year. For now company, we need to understand that we are expensing it over here, the equipment that is worth 900. So cash at the end of year 1 would be 1000 plus 1500 minus 500 minus 900, and the tax we are paying over here is not 210 but instead it is 30. If we go up, the tax is 30 because the cash expense was 1400, because we are now considering it that the 900 we are paying, and we are paying it immediately as an expense or as cash flow from operations. So we have 1070 plus 1500 minus 500 minus, now the tax at the end of second year is 300 minus 300, we have 1770, and for year 3 it would be plus 1500 minus 500, and again tax over here is 300, so we have 2470. So in the end the cash flow again is the same. Property, plant, equipment is 0 because we have already expensed it. Total asset 1000 over here, 1070, 1770, 2470. Retained earnings. Now at the net income was 70, and for each subsequent year your net income is 700. So it will be 70 plus 700, that is your 770 plus 700, that is your 1470. And we also need to understand that at the end both retained earnings, the accumulated return earnings for both companies would be the same, and these are your shareholders equity. Now the question is, which company reports higher net income over the 3 years? Total cash flow from operations. Now as we have discussed, total net income would be the same, and again the total cash flows was same as well. Now neither company reports a higher total net income or cash flow over the 3 years. The sum of net income over the 3 years is identical to 1470 whether the 900 is capitalized or expensed. As we have mentioned before as well, that the cumulative net income 70 plus 700 plus 700 is equals to 1470, and 490 plus 490 plus 490 is again the same number. Also, the sum of the change in cash flow is identical under either scenario. CAP reports higher cash from operations by amount of 900 because under the capitalization scenario, the 900 purchase is treated as an investing cash flow. So if you go back and look at the cash flow from operation, now cash flow from operation is different. Over here, if we are capitalizing your equipment, so the capitalizing part would come under cash used in investing. But if you are expensing it, then that would appear in cash flow from operation. Hence there is a difference of 900. So total cash flow from operation 790 plus 790 equals to 2370, and cash flow from operation over here is 1470. 700 plus 700 plus 70. The difference between 2370 and 1470 is 900. So 2370 minus 1470 equals to 900. And the reason being is that cash flow from operation in now is being expensed, or there is a cash outflow of 900, and over here the cash outflow is not coming from cash flow from operation, but it is coming instead from cash flow from investing. Based on return on equity and net profit margin, how does the profitability of the two companies compare? Now, as we have mentioned before, if we capitalize, early year profitability is higher, later profitability goes down. Why early the profitability is higher? Earlier the profitability is higher because we are not expensing it the entire amount, but instead we are capitalizing, and the amount that is being deducted over here is depreciation. Now if we are expensing it earlier, the profitability would be low because of the huge expense, but later year there is no expense, hence the profitability goes up. And as we see over here, if we are capitalizing, our profitability in early year is quite high, and if we are expensing it, our profitability is quite low. But later year the profitability increases when we were expensing, because in later year there is no expense, we are not deducting anything, hence the profitability goes up. But if we are capitalizing, as in the previous example, there were $300 worth of depreciation that were being deducted. As far as expensing is concerned, initially there was $900 expense, and then there were no expense. Why does now report change in cash of 70 in year 1, while CAP report total change in cash of 110? Now if you go back, the tax for when we are capitalizing, it is 210 as it is shown over here, and when we are expensing, the tax is 30, and the difference is of 180. The difference is because again when we were expensing it, it has reduced our income before tax quite considerably, and the tax rate of 30% on implied would give us a very low tax amount. And over here we are not deducting the whole 900, but instead we are depreciating and only 300 is being deducted. So our income before tax is quite high, and because of that our income tax is high as well. Now reports increase in cash of 70 in year 1, while cap reports a decrease in cash of 110 because now taxes are $180 lower than cap taxes that was of 30 versus 210 as of cap. So the cap taxes were 210 and now tax was 30. So because of this there is this difference. Now the change in cash, in cap it is 110 and now it is 70. The change in cash is 70 over here and the change in total cash is 110. So the cash change is 70 in now and minus 110 in cap. So the difference is of 180, and this difference is coming because of the difference in tax of 180. Example 5. Impact of capitalizing versus expensing for ongoing purchases. A company buys a $300 computer in year 1 and capitalizes the expenditure. The computer has a useful life of 3 years and expected salvage value of 0. So the annual depreciation using the straight line method is $100. So 300 minus 0 divided by 3, that is your number of life, it gives us $100. Now we have two scenarios, either we are capitalizing or either we are expensing. So compared to expensing the entire 300 immediately, the company's pre-tax profit in year 1 is 200 greater. Rightly so, because over here only 100 is being deducted as your depreciation, and over here the total 300 would be deducted as your purchase price of your computer. Assume that the company continues to buy an identical computer each year at the same price. If the company uses the same accounting treatment for each year of the computers, when does the profit enhancing effect of capitalizing versus expensing end? Now initially we were only deducting $100 when we were capitalizing, so our profitability was higher. Over here our profitability was lower. When would this favorable impact would be gone, or when will it end? It will end in the third year. So in the third year our total expenses would be, the expense for depreciation would be £300, and for each subsequent year we are again expensing £300 for the whole computers that we are buying. So the first year depreciation would be 100, the second year depreciation would be 100 because now we have two computers. In your third year we would have total depreciation of 300 because we have 300 computers. So if we deduct 300 depreciation, or if we deduct 300 as your expense for the purchase of computer, this will going to have the same impact. The profit enhancing effect of capitalizing versus expensing would end in year 3. In year 3, the depreciation expense on each of the 3 computers bought in year 1, 2 and 3 would total 300. And that will going to continue because at the end of 4th year, this computer that we bought in year 1 would be finished. There will be no depreciation for that. And the depreciation would be for this, the first depreciation would be 0 because now that computer is gone. Then it would be 100, 100, 100. So the depreciation will be from this computer, these 3 computers. Therefore, the total depreciation expense for year 3 will exactly equal to the capital expenditure in year 3. So the capital expenditure in year 3, as far as expense is concerned, it will be $300. The expense in year 3 would be 300 regardless of whether the company capitalize or expense the annual computer purchases. If the company buys another identical computer in year 4 using the same accounting treatment as the prior years, what is the effect on year 4 profits of capitalizing versus expensing these expenditures? Again, it would be the same for capitalize. If you capitalize or if you expense, it would be the same. Why? Because at the end of year 4, the depreciation expense would be again be of $300 and the expense would be $300 over here as well. So there is no impact on year 4 profit, as the previous year the depreciation expense on each of the 3 computers bought in year 2, 3 and 4. So the computer bought over here year 2, year 3, so year 1, year 2, year 3, year 4. So the computers that were bought in year 2, year 3 and year 4. So the depreciation at this point for all these computers would be $300 as we have mentioned. So therefore the total expenditure depreciation expense for year 4 will exactly equal to the capital expenditure in year 4. So the capital expenditure in year 4 is again $300. Hence both of them will going to give us the same pre-tax profit regardless whether the company capitalize or expense the annual computer purchase. So in simply, at the end of 4 years, our depreciation expense would be 300, that is equal to our capital expenditure of 300. So there will be no impact regardless we use capitalizing method or expensing method.